This is a brief overview of subsequent measurement issues for passive equity investments. Remember that there are two categories of equity investments: the passive kind, where the company lacks significant influence over the investee company, and the active or equity method kind. Here I am talking only about the passive equity investments. Those are where you own less than 20% of the investee company. After the company has purchased stock, it'll be entitled to receive any dividends declared. The accounting for dividends received on investments is very simple. For expediency, we don't mess with recording a dividends receivable unless it would be in an unusual situation where the dividends are declared before year-end but not paid until after year-end. We simply wait until the cash comes in, and then we debit cash and credit dividend revenue or investment revenue. Dividend revenue goes on the income statement as part of other income or expenses. That's very simple. GAAP requires that the passive stock investment on our balance sheet be reported at fair value. So this means that we also have to record an adjusting entry to bring the investment to fair value each time we prepare financial statements. We do this using an asset account called Fair Value Adjustment Account on Passive Investments. It's quite a long title. This is a valuation account, so it can carry a debit or a credit balance, but it is attached, if you will, to the passive investment account, so that when you see a reported balance sheet, you only see a combined amount for the investment account plus or minus the fair value adjustment account, and the reported amount is equal to the fair value of the investment on the reporting date. The fair value adjustment account is a permanent account, so that means its balance carries over from one year to the next. So after the first time you make the adjusting entry, you will always be making an entry that fixes the fair value adjustment account balance to be equal to the difference between historical cost of the investment and its current fair value. The other side of the fair value adjustment account adjusting entry is an account called unrealized gains or losses on passive investments, and this account always goes on the income statement. So two things you have to keep track of while you're holding a passive investment: dividends and fair value adjustments. I hope you're using a system for keeping track of each investment category and its treatment. None of them are difficult on their own, but it gets complex when you're keeping track of 5 different categories, each with its own unique accounting rules. As always, ask questions when you have them.